as we already started with it. Now we will start from paragraph 46, which is measurement. Paragraph 46 says, when or as a performance obligation is satisfied, an entity shall recognize as revenue the amount of transaction price which exclude estimates of variable consideration that are constrained in accordance with paragraph 56 to 58 that is located to the performance obligation. So what the standard is saying is that the transaction price, obviously the transaction price is defined here. The transaction price is the amount of consideration to which the entity expects to be entitled in exchange of transferring promised goods or services to a customer, excluding the amount collected on behalf of third parties. Right. This is important for you to understand that when it comes to transaction price, it will be the amount received less any amount collected on behalf of third parties. Right, so that is very important for you to take into account, candidates. Now let's go back to measurements. Determining transaction price. So we need to determine what will be that transaction price. What is that amount of consideration that an entity is expecting to receive, right? An entity shall consider the terms of the contract and its contractual business practice to determine the transaction price. The transaction price is the amount of consideration to which the entity expects to be entitled for in exchange of transferring the goods or services to the customer, excluding amounts collected on behalf of third parties. The example to that, it will be some sales and taxes. The consideration promised in a contract which with a customer may exclude fixed amount, variable amount, or both. The nature and the timing of the amount of consideration promised by a customer affects the estimates of the transaction price. When determining the transaction price, an entity shall consider the effects of the following. So the entity shall consider the effects of the following when determining the transaction price. Variable consideration, so we need to understand what is a variable consideration, and we'll look at that in paragraph 50, 59, and 55 and 59. The constraining estimates of variable consideration and the existing of significant financing component in the contract. Non-cash consideration and consideration payable to the customer. For the purpose of determining transaction price, an entity shall assume that the goods or services will be transferred to customer as promised in accordance with existing contracts, and that the contract will not be cancelled or renewed or modified. Now, variable consideration. What is a variable consideration? So you need to understand what is that variable consideration that we're talking about above. As per paragraph 15, if the consideration promised in the contract includes a variable amount, an entity shall estimate the amount of consideration to which the entity will be entitled in exchange of transferring goods or services to the customer. Paragraph 59, an amount of consideration can vary because of discount, rebate, refunds, credit, price concession, incentive, performance bonus, penalties, and other similar items. The promised consideration can also vary if the entity entitlement to the consideration is contingent on the occurrence or non-occurrence of future event. For example, an amount of consideration will be variable if either a product was sold with a right of return or the fixed amount is promised as a performance bonus on achieving a specified milestone. So now if there is a return, a fixed amount that is promised if the performance bonus or achieving of the specific milestone, then that means there is a variable consideration. Now let us make an example. What do we mean by variable consideration in a way that everyone might best understand it? So a variable consideration will be instances where when the product is sold, the customer is given an opportunity to return the product. So that creates a variable consideration. And also if the revenue is based on the client achieving certain milestone. So on achievement of that milestone, the revenue of the entity changes. So that also creates variable consideration. Paragraph 52. The variability relating to the consideration promised by the customer may be explicitly stated in the contract. In addition to the terms of the contract, the promised consideration is variable if either of the following circumstances exist. A customer has a valid expectation arising from an existing customary business practice, published policies, or specific statement that the entity will accept an amount of consideration that is less than the price stated in the contract. That is, if they expected that the entity will offer a price concession. Depending on the jurisdiction, industry, or customer, this offer may be referred to as a discount, rebate, or refund. So, discount, rebate, and refunds, or even credits, they are part of the what we call variable consideration. So if the customer is expecting to get discount, rebate, refunds, or credits, then in that instance, we are saying that they are getting variable consideration. Other facts and circumstances indicate that the entity intention when entering into the contract with customer is to offer a price concession to the customer. Now let's just look at 53. What does 53 say? An entity shall estimate an amount of variable consideration by using either the following methods, depending on which method the entity expects to better predict the amount of consideration to which the entity will be entitled. The expected value. The expected value is the sum of probability weighted amount in a range of possible consideration amounts. An expected value may be appropriate estimate of the amount of variable consideration if an entity has a large number of contracts with a similar characteristics. And then the second one, which is B, the amount or the most likely amount. The most likely amount is the single most likely amount in a range of possible consideration amount. That is the single amount likely outcomes of the contract. The most likely amount may be an appropriate estimate of the amount of the variable consideration if the contract has only two possible outcomes. For example, the entity either achieves the performance bonus or does not. Right. Now let's look at paragraph 54. What does it say in line with the variable consideration? An entity shall apply one method consistently throughout the contract when estimating the effects of any uncertainty of an amount of variable consideration to which entity will be entitled. In addition, an entity shall consider all the information, historical, current, and forecast, that is reasonable available to the entity and shall identify a reasonable number of possible consideration amount. The information that an entity uses to estimate the amount of the variable consideration will typically be similar to the amount that the entity management uses during the bid and the proposal process and in establishing the price for the promised goods or services. Now we're going to look at the refund liability. An entity shall recognize a refund liability if the entity receives consideration from a customer and expect to refund some or all of the consideration to the customer. A refund liability is measured at the amount of consideration received or receivable for which the entity does not expect to be entitled, amount not included in the transaction price. The refund liability and the corresponding change in the transaction price and therefore the contract liability shall be updated at the end of each reporting period for the change in circumstances. To account for refund liability relating to sales with a right of return, an entity shall apply guidance in paragraph B20 to B27. Containing estimate of variable consideration. So we're still looking at variable consideration. An entity shall include in the transaction price some or all of the amount of the variable consideration estimated in accordance with paragraph 53, only to the extent that it is highly probable that the significant reversal in the amount of cumulative revenue recognized will not occur when an uncertainty associated with the variable consideration is subsequently resolved. Paragraph 57. In assessing whether it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur once the uncertainty related to variable consideration is subsequently resolved, an entity shall consider both and the likelihood and the magnitude of the revenue reversal. Factors that could increase the likelihood of the magnitude of revenue reversal include, but not limited to, any of the following. The amount of consideration is highly susceptible to factors outside the entity's influence, Those factors may include volatility in the market, the judgment or action of third parties, weather consideration, and the high risk of obsolete of the promised goods or services. B. The uncertainty about the amount of consideration is not expected to be resolved for a long period of time. The industry experience with similar types of contracts is limited, or that experience has limited predictive value. D. The entity has a practice of either offering broad range of price concession or changing the payment terms and conditions of similar contracts or similar circumstances. And in E, the contract has a large number of broad range of possible consideration amount. Then we're looking at paragraph 58 while we're still on variable consideration, and the entity shall apply paragraph B53 to account for consideration in the form of sale-based or usage-based royalty that is promised in exchange for the license of intellectual property. Reassessment of variable consideration. At the end of each reporting period, an entity shall update the estimated transaction price, including updating its assessment of whether an estimate of the variable consideration is constrained to represent faithfully the circumstances presented as at the end of the reporting period and changes in the circumstances during the reporting period. The entity shall account for the change in transaction price in accordance with paragraph 87 to 90. The existence of significant financing components in a contract. Now we are done with variable consideration. Now we're talking about significant financing component in the contract. In determining the contract's price, an entity shall adjust the promised amount of consideration for the effects of the time value of money and the timing of payment agreed to by the parties to a contract, either explicitly or implicitly provide the customer to the entity with significant benefit of the financing, the transfer of goods or services to the customer. In those circumstances, the contracts contain a significant financing component. A significant financing component may exist regardless of whether the promise of financing is explicitly stated in the contract or implied with the payment terms agreed to by the parties to the contract. Paragraph 61. The objective when adjusting the promised amount of consideration to the financial contract is for an entity to recognize the revenue as an amount that reflects the price that the customer would have paid for the promised goods or services if the customer had paid for those goods or services when they transfer to the customer, that is cash selling price. An entity shall consider all relevant facts and circumstances in assessing whether a contract contains a financing component and whether that financing component is significant to the contract, including both the following. So how does then the entity see whether the financing component is significant to a contract? The difference, if any, between the amount promised consideration and the cash selling price of the promised goods and the combined effects of both of the following. The expected length of time between when the entity transfer the promised goods or services to the customer and when the customer expects to for those goods or services, and the prevailing interest rate in the relevant market. Notwithstanding the assessment of paragraph 61, a contract with customer should not have a significant financing component if any of the following exist. The goods paid for the goods, the customer paid for the goods or services in advance, and the timing of the transfer of goods or services is at the discretion of the customer. A substantial amount of consideration promised by the customer in a variable is variable, and the amount or timing of that consideration varies on the basis of occurrence or non-occurrence of future event that is not substantial within the control of customer or the entity. The difference between the promised consideration and the cash selling price of the goods or services arise for a reason other than the provision of finance to either the customer or the entity, and the difference between those amounts is proportional to the reason of the difference. For example, the payment terms might provide the entity, a customer, the protection from the other party failing to adequately complete some or all of the obligation under the contract. Now, looking at paragraph 63, as a practical expedient, An entity need to adjust the promised amount of consideration for the effects of the significant financing component if the entity expect at the contract inception that the period between when the entity transfers the promised goods or services to a customer and when the customer pays for that goods or services will be 1 year or less. So practical experiences, if then the delivery of goods and the payment of that goods is within a year or less, then they do not have to take into account of the financing component. 64. To meet the objective in paragraph 61, when adjusting the promised amount of consideration for the significant financing component, an entity shall use the discount rate that will be reflected in the separate financing transaction between the entity and its customer at contract inception. The rate would reflect the credit characteristics of the party receiving financing in the contract, as well as any collateral or security provided by the customer on the in the entity in the contract, as well as any collateral or security provided by the customer on the entity, including asset transferred in the contract. An entity may be able to determine that rate, identify the rates that discount a normal amount of promised goods to price that the customer would pay in cash for the goods or services when they transfer to the customer. After contract inception, the entity shall not update the discount rates for changes in interest rates of other circumstances, such as change in the assessment of customer credit risk. And then looking at 65, an entity shall present the effects of financing, interest revenue, or interest expense separately from revenue from contracts with customer in the statement of comprehensive income. Interest revenue or interest expense is recognized only to the extent that a contract asset or receivable of a contract liability is recognized in accounting for contracts with customer. Non-cash consideration. To determine the transaction price for the contracts with customer, the promised consideration is a form other than cash, and this shall measure the non-cash consideration or promise of non-cash consideration at fair value. If an entity cannot reasonably estimate the fair value of the non-cash consideration, the entity shall measure the consideration indirectly by reference to the standalone selling price of the goods or service promised to the customer in exchange for the consideration. And in paragraph 68, the fair value of non-cash consideration may vary because of the form of consideration. For example, a change in the price of a share to which the entity is entitled to receive from customer. If the fair value of the non-cash consideration promised by the customer varies for a reason other than only the form of consideration, for example, the fair value could vary because of the entity performance, and this shall apply the requirements of paragraph 56 to 58. 69. If a customer contributes goods or services, for example, material, equipment, or labor, to facilitate an entity's fulfillment of contracts, the entity shall assess whether it obtains control of those contributed goods or services. If so, the entity shall account for the contributed goods or services as a non-cash consideration received from customer. Consideration payable to the customer. Paragraph 70. Consideration payable to the customer include cash amount that an entity pays or expect to pay to the customer. Consideration payable to the customer also include credit or other items, for example, a coupon and a voucher that can be applied against the amount owed to the entity. An entity shall account for the consideration payable to the customer as a reduction of the transaction price and therefore of revenue unless payable to the customer in exchange for a distant goods or services that the customer transfer to the entity. If consideration payable to the customer includes a variable amount, an entity shall estimate the transaction price in accordance with 50 to 58. So that is the consideration payable to the customer. It should exclude the vouchers if those vouchers will not be used to buy other products. If consideration payable to a customer is payable for distant goods or service from the customer, then an entity shall account for the purchase of the goods or services in the same way that it accounts for other purchases from the suppliers. If the amount of consideration payable for the customer exceeds the fair value of the distant goods or services that the entity receives from the customer, then the entity shall account for such an excess as a reduction in the transaction price. If the entity can now reasonably estimate the fair value of the goods or services received from the customer, it shall account for all of the consideration payable to the customer as a reduction of the transaction price. Paragraph 72. Accordingly, if consideration payable to the customer is accounted for as a reduction of the transaction price, an entity shall recognize the reduction of revenue when or as at a later either the following events occur. The entity recognizes revenue for the transfer of related goods or services to the customer, and the entity pays or promises to pay the consideration. That promise might be implied by the entity customary business practice. Allocating the transaction price to performance obligation. The objective when allocating the transaction price is for an entity to allocate the transaction price to each performance obligation or distance goods or services in an amount that depicts the amount of consideration for which the entity expects to be entitled in exchange for transferring the promised goods or services to the customer. So now, allocating transaction price to performance obligation. The objective when allocating transaction price is for an entity to allocate transaction price for each performance obligation, right? And 3. Right. So, and then we talk about the performance obligation. It's a distance, goods or services, right? If an amount that predicts the amount of consideration to which the entity expects to be entitled in exchange for transferring the promised goods or service to the customer. To meet the allocation objective, an entity shall allocate the transaction price to each performance obligation identified in the contract on a relatively stand-alone selling price basis in accordance with paragraph 76 to 80, except as specified in paragraph 81 to 83. Paragraphs 76 to 86 do not apply if the contract has only one performance obligation. However, paragraph 84 to 86 may apply if an entity promised to transfer a series of distance goods or services identified as a single performance obligation, and the promised consideration includes a variable amount. So it is very important that you understand the variable amount and the term of the variable amount. Allocation based on stand-alone selling price. To allocate the transaction price to each performance obligation on a relative stand-alone selling price basis, an entity shall determine the stand-alone selling price at contract inception of the distance goods or service underlying each performance obligation in the contract and allocate the transaction price in proportion to the stand-alone selling price. So candidates, you need to look at the examples of allocating the stand-alone selling price so that it will be easy for you to understand how to allocate the stand-alone selling price. The stand-alone selling price is the price at which an entity would sell the promised goods or service separately to customer. The best evidence of stand-alone selling price is the observable price of goods or service when the entity sells that goods or service separately in similar circumstances and to similar customer. The contractual stated price or list price for the goods or service may be the stand-alone selling price of that service or good. 78. If a stand-alone selling price is not directly observable, an entity shall estimate the stand-alone selling price as an amount that would result in the allocation of the transaction price meeting the allocation objective in paragraph 73. When estimating the stand-alone selling price, an entity shall consider all information including market condition, entity-specific factors, information about customer and class of customer, and that is reasonably available to the entity. In doing so, the entity shall maximize the use of observable input and apply estimation method consistently in similar circumstances. Then we're looking at 79. Suitable method for estimating the stand-alone selling price of good or service include, but are not limited to, the following. A. Adjusted market assessment approach. An entity could evaluate the market in which it sells goods or services and estimate the price that a customer in that market will be willing to pay for those goods or services. That approach might also include referring to prices from the entity competitors for similar goods or services and adjusting those prices is necessary to reflect the entity cost and margin. B. Explicit cost plus margin approach. An entity could forecast its explicit cost of satisfying performance obligation and then add an appropriate margin for that goods or services. Then they can also use what we call a residual approach. And when you're looking at the residual approach, an entity may estimate the standalone selling price by reference to the total transaction price less the amount of the observable standalone selling price of other goods or services promised in the contracts. However, an entity may use the residual approach to estimate in accordance with paragraph 78 and standalone selling price of goods or services only if one of the following criteria are met. So there is a criterion that need to be met if then C is applied. Number one, the entity sells the same goods or service to different customers for a broad range of amounts, or the entity has not yet established a price for the goods or services and the good or service has not previously been sold on a standalone basis. Now when you're looking at paragraph 80, paragraph 80 says a combination of methods may need to be used to estimate the standalone selling price of goods or service promised in a contract if two or more of those goods or services have highly variable or uncertain standalone selling price. For example, an entity may use a residual approach to estimate the aggregate standalone selling price for those promised goods or services with a highly variable or uncertain standalone selling price, and then use another method to estimate the standalone selling price of the individual goods or services relative to that estimate aggregate standalone selling price determined by the residual approach. When an entity uses a combination of methods to estimate the standalone selling price of each promised good or service in a contract, the entity shall evaluate whether allocation of the transaction price and those estimated standalone selling price would be consistent with allocation objective in paragraph 73 and requirement of estimate of standalone selling price in paragraph 78. Allocation of a discount, which is in the paragraph 81. A customer receives a discount for purchasing a bundle of goods or services if the sum of the standalone selling price of those promised goods or services in a contract exceeds the promised consideration in a contract, except when an entity has observed evidence in accordance with paragraph 82 that the entire discount relates only one or more, but not all, performance obligation in a contract. The entity shall allocate discount proportionately to all performance obligation in the contract. The proportional allocation of the discount in those circumstances is consequence of the entity allocating the transaction price to each performance obligation on the basis of relative standalone selling price of the underlying distant goods or services. So what does that mean? It means that if you have three products that you're selling as a bundle and you're providing the discount, unless you can say that it's only product A that is getting a discount, you need to allocate the discount to all the products. Paragraph 82. An entity shall allocate a discount entirely to one or more, but not all performance obligation in the contract if all of the following criteria are met. The entity regularly sells each distance good or services in the contract on a standalone basis. The entity also regularly sells on a standalone basis a bundle of some of the distance goods or services at a discount to the standalone selling price of goods or service in each bundle, and the discount attributable to each bundle of goods or service distributed in paragraph 82b is substantially the same as the discount in the contract, and any analysis of the goods or service each bundle provides observable evidence of performance obligation on which the entire discount in the contract belongs. 83. If a discount is allocated entirely to one or more performance obligation in the contract in accordance with paragraph 82, an entity shall allocate the discount before using a residual approach to estimate the standalone selling price of a goods or service in accordance with paragraph 79c. Allocation of variable consideration. Variable consideration that is promised in a contract may be attributable to the entire contract or to a specific part of the contract, such as either of the following: one or more but not all performance obligation in the contract, or one or more but not all contracts distance goods or service promised in a series of distance goods or services that form part of a single performance obligation according to paragraph 22b And then when you're looking at 85, 85 says an entity shall allocate a variable amount and subsequent changes to that amount entirely to performance obligation or distance goods or services that performs that forms part of a single performance obligation according to paragraph 22b if both of the following criteria are met. A, we're saying the terms of the variable amount relates specifically to the entity's effort to satisfy the performance obligation or transfer the distance goods or services. B, allocating the variable amount of consideration entirely to the performance obligation or distance goods or services is consistent with the allocation objective 7.3 when considering all of the performance obligation and payment terms in the contract. 86. The allocation requirement in paragraph 73 to 83 shall be applied to allocate the remaining amount of the transaction price that does not meet the criteria in paragraph 85. Changes in the transaction price. So what do we do if there is a change in the transaction price, which is the price that the entity expects to receive as a result of contracts? After contract's inception, the transaction price can change for various reasons, including the resolution of uncertain events or other changes in the circumstances that change the amount of consideration to which the entity expect to be entitled in exchange for promised goods or services. So what is said now is that after the contract's inception, there were issues that during the contracts were not certain, now they have become certain. Now the price will therefore change to address those uncertainty that were there during the contract's inception. Now we're going to look at 88. An entity shall allocate to the performance obligation in the contract any subsequent changes in the transaction price on the same basis as at the contract's inception. Consequently, an entity shall not allocate the transaction price to reflect changes in the standalone selling price after contract's inception. Amounts allocated to satisfy performance obligation shall be recognized as revenue or as a reduction of revenue in the period in which transaction price changes. 89 says an entity shall allocate a change in the transaction price entirely to one or more but not all performance obligation or distance goods or service promised in a series forms part of single performance obligation in accordance with paragraph 22b only if criteria in paragraph 85 of the allocating variable considerations are met. Now if you're looking at 90, it says an entity shall account for a change in the transaction price that arises as a result of contract modification according to paragraph 18 to 21. However, for a change in the transaction price that occur after a contract modification, an entity shall apply paragraph 87 to 89 to allocate the change in the transaction price in whichever of the following ways is applicable. A. An entity shall allocate the change in the transaction price to the performance obligation identified in the contracts before the modification if and to the extent that the change in the transaction price is attributable to amount of variable consideration promised before the modification and the modification is accounted for in accordance with paragraph 21a. And then we're looking at B. In all other cases in which the modification was not accounted for as a separate contract in accordance with paragraph 20, the entity shall allocate the change in the transaction price to the performance obligation in a modified contract. That is the performance obligation that were unidentified or partially unused immediately after the modification. Then now we are done with the measurements. Then let us look at the contract cost. So what do we have in the contract cost? Incremental cost of obtaining the contract. An entity shall recognize as an asset the incremental cost of obtaining a contract with customer if the entity expect to recover those costs. The incremental cost of obtaining the contracts are those costs that an entity incurs to obtain a contract with a customer that it would not have incurred if the contract had not been obtained. For example, the sales commission. Cost of obtaining the contract that would have been incurred regardless of whether the contract was obtained shall be recognized as an expense when incurred, unless those costs are explicitly chargeable to the customer regardless of whether the contract is obtainable. So when you're talking about incremental costs, some of the example will be the sales commission. If that sales commission was needed to obtain the contract, then it should be recognized, right? As practical expedient, an entity may recognize and the incremental cost of obtaining contracts as an expense when incurred if the amortization period of the asset that entity otherwise would have recognized in 1 year or less. Cost to fulfill the contracts. If the costs incurred in fulfilling the contracts with the customer are not within the scope of another standard, for example, IFRS 2, International Accounting Standard 16 or 38, which is intangible assets, an entity shall recognize an asset from the cost incurred to fulfill the contracts only if those costs meet all the following criteria. So it is important to know we're saying all, not some. The costs relate directly to a contract or to an anticipated contract that the entity can specifically identify. The cost generates or enhance resources of the entity that will be used in satisfying performance obligation in the future and the cost expected to be recovered. So it's very important that all of this is satisfied. For the costs incurred in fulfilling the contracts with the customer that are within the scope of another standard, entities shall account for those costs in accordance with those standards. 97 says costs that relate directly to a contract, direct labor, direct material, allocation of costs relating directly to the contract, costs that are explicitly chargeable to the customer under the contract, and other costs that are incurred only because of the entity entered into the contract. And then 98 says an entity shall recognize the following costs as expense when incurred. Right. General and administrative costs, unless those costs are explicitly chargeable to the customer under the contract, in which case an entity shall evaluate those costs in accordance with paragraph 97. So general and administrative costs should not be recognized as revenue. Cost of wasted material, labor, or other resources to fulfill the contracts that were not reflected in the price of the contracts, costs that relate to satisfied performance obligation in the contracts, costs for which the entity cannot distinguish whether the costs relate to unsatisfied performance obligation or to satisfied performance obligation, and then amortization and impairment. An asset recognized in accordance with paragraph 91 or 95 shall be amortized on a systematic basis that is consistent with the transfer of the customer of the goods or services to which the asset relates. The asset may relate to goods or services to be transferred under the specific anticipated contract. An entity shall update the amortization to reflect a significant change in entity's expected timing of transfer to the customer of the goods or services to which the asset relates. Such a change shall be accounted for as a change in accounting estimate. An entity shall recognize an impairment loss in profit or loss to the extent that the carrying amount of an asset recognized in accordance with paragraph 91 or 95 exceed the remaining amount of consideration that the entity expects to receive in exchange for the goods or services to which the asset relates, less the costs that relate directly to providing those goods or services and that have not been recognized as an expense. And then looking at paragraph 102 says, for the purpose of applying paragraph 101 to determine the amount of consideration that an entity expects to receive, an entity shall use the principle for determining the transaction price and adjust that amount to reflect the effects of customer credit risk. And then when you're looking at 103, before the entity recognizes an impairment loss for an asset recognized in accordance with paragraph 91 to 95, the entity shall recognize an impairment loss for assets related to contracts that are recognized in accordance with another standard. Then let's move to the next paragraph, which is 104. An entity shall recognize in profit or loss a reversal of some or all of the impairment loss previously recognized in accordance with the paragraph 101 when the payment condition no longer exists or have improved. The increase in carrying amount of the asset shall not exceed the amount that would have been determined if no impairment loss has been recognized previously. Presentation. When either party to a contract has performed, an entity shall present the contracts in the statement of financial position as a contract asset or contract liability, depending on the relation between the entity's performance and the customer payment. An entity shall present an unconditional right to consideration separately as receivable. So, when either party of a contract has performed, an entity shall present the contract in the statement of financial position as a contract asset or contract liability, depending on the relationship between the entity's performance and customer payments. An entity shall present any unconditional right to consideration separately as receivables. If a customer pays consideration or an entity has a right to an amount of consideration that is unconditional, that is a receivable, before the entity transfers goods or service to the customer, the entity shall present the contract as a contract liability when the customer is the payment is made or the payment is due. A contract liability is an entity's obligation to transfer goods or service to the customer for which the entity has received consideration from the customer. And then when looking at 107 says if an entity performs by transferring goods or service to a customer before the customer pays consideration or before payment is due, the entity shall present the contract as a contract asset, excluding any amount presented as a receivable. A contract asset is an entity right to consideration in exchange for goods or services that the entity has transferred to the customer. An entity shall assess a contract asset for impairment in accordance with IFRS 9. An impairment of contract assets shall be measured, presented and disclosed on the same basis as financial assets within the scope of IFRS 9. 108 talks about a receivable. A receivable is an entity's right to consideration that is unconditional. A right to consideration is unconditional if only the passage of time is required before payment of that consideration is due. For example, an entity will recognize a receivable if it has a present obligation to payment, even though the amount may be subject to refunds in future. An entity shall account for receivable in accordance with IFRS 9 upon initial recognition of receivable from the contracts with customer. Any difference between the measurements of the receivable in accordance with IFRS 9 and the corresponding amounts of revenue recognized shall be presented in expense, for example, impairment loss. And then 109. 109 states this standard uses the term contract assets and contract liability but does not prohibit an entity from using alternative description in the statement of financial position for those items. If an entity uses an alternative description for a contract asset, the entity shall provide sufficient information for users of the financial statement to distinguish between receivables and contract asset. Disclosure. Now we've done presentation, then we need to look at disclosure. How then do we disclose the revenue in the books of the company or the entity? The objective of the disclosure requirement is for the entity to disclose sufficient information to enable the user of the financial statement to understand the nature, the amount, timing, and understanding of revenue and cash flows arising from contracts with customer. To achieve that, the objective, an entity shall disclose qualitative and quantitative information about the following. So it is important to take note, candidate, that the qualitative and quantitative information is required in the disclosure so that the users of the financial can understand the nature, the amount, and timing, as well as uncertainty of the revenue. So what is required, or what will the user wish to see in order to meet the qualitative and quantitative objective? In a contract with customer, and the significant judgments and uncertainty in management made in applying the standards to those contracts, any asset recognized from the cost of obtaining or fulfilling the contracts with the customer in accordance with paragraph 91 to 95. An entity shall consider the level of detail necessary to satisfy the disclosure objective and how much emphasis to place on each of the various requirements. An entity shall aggregate or disaggregate disclosure so that useful information is not obscured by either the inclusion of the large amount or insignificant details of aggregate or the aggregate of items that have substantially different characteristics. And then looking at 112, an entity need not disclose information in accordance with the standard if it has been provided information in accordance with another standard. So if the other standard has the information, then that information should not be presented under revenue. Contracts with customer. An entity shall disclose all the following amount for the reporting period unless those amounts are presented separately in the statement of financial of comprehensive income in accordance with other standard. 1. There should be the revenue recognized from contracts with customer, which the entity shall disclose separately from other revenue. Any impairment losses recognized or any receivable or contract asset arising from the entity contracts with customer, which the entity shall disclose separately from the impairment losses from the contracts. And then we're going to look at the disaggregate of revenue. An entity shall disaggregate revenue recognized from contracts with customer into categories that depict how the nature, amount, timing, and uncertainty of a revenue and cash cost are expected by economic factors. An entity shall apply the guidance in paragraph B87 to B89 when selecting the categories to use to disaggregate revenue. In addition, an entity shall disclose sufficient information to enable the user of financial statement to understand the relationship between the disclosure of disaggregated revenue and the revenue information that are disclosed in each reportable segment if the entity applies IFRS 8 operating segment. Contracts balances. An entity shall disclose all the following: the opening and closing balance of receivable, contract asset, contract liability from contracts with customer, if not otherwise separately presented or disclosed. Revenue recognized in reporting period that was included in the contract liability balance at the beginning of the period, and the revenue recognized in the reporting period from performance obligations satisfied in previous period. And then when looking at 117, an entity shall explain how the timing of satisfaction of the performance obligation relate to the typical timing of payment and the effect that those factors have on the contract asset and the contract liability balances. The explanation provided may use qualitative information. An entity shall provide an explanation of the significant changes in the contract assets and the contract liability balances during the reporting period. The explanation shall include qualitative and quantitative information. Examples of changes in the entity balances or contract assets and contract liability include any of the following: change due to business combination, cumulative catch-up adjustment to revenue that affects the corresponding contract asset or contract liability, including adjustment arising from change in the measurements progress, or changes in the estimate of the transaction price, including changes in the statement of whether the variable consideration contracts or contracts information modification. Impairment contracts, the change in time frame of right to consideration to become unconditional, a change in the time frame for the performance obligation to be satisfied. Performance obligation, an entity shall disclose information about the performance obligation in contracts with customer, including the description of all the following: when the entity typically satisfies the performance obligation, including when performance obligation are satisfied in a bill and hold arrangement, the significant payment terms, the nature of the goods or services that the entity has promised to transfer, highlighting any performance obligation to arrange for another party of transfer goods or services. Obligation for return, refunds, and other similar obligation and types of warranty and related obligation. Transaction price allocated to remaining performance obligation. P120, an entity shall disclose the following information about the remaining performance obligation: the great amount of the transaction price allocated to the performance obligation that are unsatisfied, and the explanation of when the entity expects to recognize revenue in amount disclosed in accordance with paragraph 120A, which the entity shall disclose in either of the following ways: on a quantitative basis, using the time bands that would be most appropriate for the direction of remaining performance obligation by using quantitative information. And we're looking at 121. As a practical expedient, an entity need to disclose the information in paragraph 120 for the performance obligation if either of the following conditions are met: the performance obligation in part of the contract that has an original expected duration of 1 year or less, the entity recognizes revenue from the cessation of payments obligation in accordance with paragraph B. An entity shall explain qualitative whether it is applying the practical expedient in paragraph 121 and whether any consideration from the contracts with customer is not included in transaction price and therefore not included in the information disclosed in accordance with paragraph 120. For example, an estimate of the transaction price would not include any estimate amount of variable consideration that are constrained. Significant judgments in the application of the standard. An entity shall disclose the judgments and changes in the judgments made in applying the standard that significantly affect the determination of the amount and the timing of revenue from the contracts with customer. In particular, an entity shall explain the judgments and changes in the judgment used in determining both the timing of satisfying the performance obligation, the transaction price, and the amount allocated to the performance obligation. And then 124, determine the timing of satisfaction of performance obligation. For the performance obligation that an entity satisfies over time, an entity shall disclose both the following: the method used to recognize the revenue and the explanation of why the method used provides faithful prediction of the transfer of goods or services. For the performance obligation satisfied at a point in time, an entity shall disclose the significant judgments made in evaluating when the customer obtained control of promised goods or services. Then we move to determine transaction price and amount allocated to performance obligation. 126, an entity shall disclose information about the methods, inputs, and assumptions used for all the following: determining transaction price, which include but is not limited to estimating variable consideration, adjusting the consideration for the fact of the time value of money, and the measuring of non-cash consideration. Assessing whether an estimate of variable consideration is constrained, allocating the transaction price, including estimating standalone selling price of promised goods or services allocated discount, and measuring obligation for returns, refunds, and other similar obligation. As it recognized from cost to obtain or fulfill the contract with customer, an entity shall describe both the following: the judgments made in determining the amount of cost incurred to obtain or fulfill a contract with customer, and the method it uses to determine the amortization for each reporting period. An entity shall disclose the following: the closing balance of asset recognized from the cost incurred to obtaining or fulfilling the contract with customer by main category of asset, the amount of amortization and impairment losses recognized in the reporting period, then practical expedience. If an entity elects to use the practical expedient in either paragraph 63, the entity shall disclose that first. Then after that, we'll be looking at appendixes or definition and terms. This will take us to the end of class 2 of IFRS 15, revenue from sale with contract.